Hi, and welcome to Selling High-Deductible Health Insurance Plans, presented by the Independent Life Insurance Agent Association. Today we're going to talk about how high-deductible health insurance plans fit into your portfolio and how you, even as a life insurance agent, can branch out and add these HDHPs into what you're doing and boost your career to the next level. So first things first, what's the HDHP? These melange of letters stand for High-Deductible Health Insurance Plan. This is a type of insurance that doesn't have a whole lot of moving parts, and it's a type of health insurance that's becoming more and more popular with agents and with consumers. It's also a type of insurance that's got what we call HSA compatibility. In other words, it's eligible for a health savings account. And this is a special kind of tax-sheltered savings account that you can put a limited amount of money into each year and then spend that money on qualified medical expenses. It's a really cool way to get a little bit of a tax break alongside your health insurance plan. And these plans also usually have an integrated prescription deductible, so once your deductible is taken care of, you know you're pretty much done. The way a high-deductible health insurance plan works is, like we said, there are not a lot of moving parts. There's no copay here, there's no co-insurance, there's no true out-of-pocket. You have a deductible. And if you go to a doctor, you're going to pay that doctor's bill. It's not going to be a copay, it's going to be the full value of the bill. Well, not the full value. Since you have a high-deductible health insurance plan, you're going to get what's called a negotiated rate. So you'll pay the same rate that your insurance company would have paid to reimburse your doctor when they billed the insurance carrier. You'll pay that money, you'll get it counted towards your deductible. Once you reach your deductible, that's it. No more health expenses for the rest of the year. Anything that would be covered by your health insurance plan is going to be paid by your health insurance company at 100%. So maybe you pay a little bit more for a prescription or two up front, and maybe your doctor's visits may be a little bit more expensive and the bills are a little bit more unpredictable. But it's going to pay off in the end when you hit that deductible and you've got no more expenses whatsoever. So how do we compare these plans? Typically, when we're talking to consumers about health insurance, they're familiar with the type of insurance that they've got through work, which is usually our traditional copay style health insurance. Put side by side with our high-deductible health insurance plans, how do these copay-style plans stack up? Well, like we said, copay-style insurance plans are a little bit more familiar to consumers, whereas high-deductible health insurance is a newer concept, although it is gaining ground and more people are becoming familiar with it. With copay-style health insurance, you know exactly what you're getting into when you go to a doctor. You know if it's an office visit with a copay, you're paying whatever that copay is, $25, $35, $50, whatever. With high-deductible health insurance plans, your bills are going to vary. You'll pay whatever the cost of that office visit is, whatever the cost your insurance company would have paid your doctor when they billed them, that's the cost you'll pay. Now, the cost that's being billed is going to be applied to your deductible, and once you've met that deductible again, there's no more cost to you for the rest of the year. So your upfront cost for doctor's visits and prescriptions work the same way here, are going to be a little bit higher up front, but once you hit that deductible, there's no more cost at all. That's not how it works with copay style insurance. Once you hit your deductible, then you go into your co-insurance. So for instance, let's say you have a traditional copay style health insurance plan that has a $1,000 deductible and then a 20% co-insurance to a $2,000 out-of-pocket. Here's what happens. If you get a $1,000 bill, medical bill, you go to the hospital, you have surgery, it costs $1,000 or whatever, it's a cheap surgery, you're going to pay that $1,000. That's your deductible. And it didn't fall under a copay because it wasn't an office visit, it's your deductible. So you pay that $1,000. Now you've met your deductible. Now you're in your co-insurance phase, and you have co-insurance up to another $1,000, $2,000 total. You go back to the hospital, you get another bill, it's another $1,000. Now you're going to be responsible for 20% of that amount, or $200, and the insurance company is going to pay their share of the co-insurance, $800. And that's the arrangement you're going to have until you pay another $1,000 out of pocket and you hit your $2,000 total out of pocket. So you have that deductible, then you have a share of cost up to your true out of pocket. With high deductible health insurance, it's less complicated. You hit your deductible and you're done. After that point, your insurance company is paying 100% of everything. Prescriptions, doctor's visits, hospitalization, everything. After you hit your deductible under a copay-style health insurance plan, and even after you hit your true out-of-pocket and you're done with your co-insurance, you're still going to have copays for office visits. So really, there's no limit to the out-of-pocket cost you're going to have with a copay-style health insurance plan. You're always going to have that copay no matter what, even if you fit your deductible and your true out-of-pocket. With that high-deductible health insurance plan, there's no cost to you after the deductible. Your prescriptions, your office visits, surgery, ER visit, MRIs, everything. It's all covered at 100%. Your traditional copay-style health insurance is going to have a slightly higher premium, and in some cases a much higher premium when compared to your high-deductible health insurance plans, and the true cost of ownership in your traditional copay-style plan is higher than when compared to your high-deductible health insurance plan. Now that last point is really important. The true cost of ownership is really the metric that matters the most. Now let's take a look at what we mean here. This is a comparison of 3 different health insurance plans for a hypothetical 47-year-old male who does not use tobacco. All right, 3 different plans. We just ran a quick quote on ehealthinsurance.com to pull a couple of different comparative rates. Our first row here is an HSA style plan. Our second row is a copay style plan. And our third row is a copay style plan that has limited copays. So let's compare these different plans and see how they stack up. You can see our HSA style plan in that first row there has a $5,000 deductible, whereas our other 2 copay style plans have $3,500 deductibles. So that deductible is a little bit lower for the copay plan. Okay? But when you look at coinsurance, our HSA style plan has 100% coinsurance. That means once you hit that deductible, the insurance company is paying everything else. In the middle, 20% coinsurance, and our last plan here is a 30% coinsurance. That number is the share of cost you're going to have once you hit your deductible. So if it says 20%, I know this is a little bit confusing because 100% at the very top means that the insurance company is paying everything, and the 20 and 30% here mean what you're paying, but this is how insurance companies are typically going to write this. So the coinsurance of 20% means that after you hit your deductible of $3,500, any bills you get from there on out, you're only going to pay 20% of that amount, or 30% depending on the plan, until you hit your true out-of-pocket, which in our middle row here with our unlimited copay plan is $6,000, and the bottom is $6,500. Now, we saw in the first part here that our deductible on the copay style plans were lower, but if we look at our total out-of-pocket limit, we can see that we're actually exposed to more liability with those copay style plans. When we meet that $5,000 deductible on our high deductible health insurance plan, we're done. Our total out-of-pocket liability for the year, the maximum we can ever be liable for, is $5,000. Our maximum liability on these other 2 plans, $6,000 or $6,500. Now, what happens if we go to an office visit, just go see the doctor, we have the cold or something? Our copays, if we have this middle plan here in the middle row, it's $35 every time, and that's unlimited. You can go to the doctor as much as you want. In the bottom row here, we have a limited number of copays. We have 3. So the first 3 office visits are going to be covered by that $35 copay, and then you're just going to have to pay the full amount of the bill until you meet your deductible, just like you would with this high deductible health insurance plan. In our top row here, the high deductible plan, no copays at all. If you go to the doctor, you're going to pay the full bill. And once you've paid $5,000 towards your medical expenses for the year, you don't pay anything else at all. Now let's compare the premiums. This is where things start to get really interesting. The premium on that high deductible health insurance plan, as you can see, is $143.35 a month. In the middle row, with our unlimited copay plan, it's $247.14 a month. And down at the bottom, we're at $152.91. And this is really interesting. Look back at the out-of-pockets. The out-of-pocket is your total potential maximum liability. And you can see that in our high deductible plan, it's $5,000. It's the lowest. And yet it's also the lowest premium. So for these other 2 plans, you're actually paying more to be exposed to more liability. And let's break that down. Let's look at that a little more closely. And there's a really cool way to illustrate this, and you can use this with your clients as well. What happens with these different plans in a best-case scenario versus a worst-case scenario each year? Well, with our high-deductible health insurance plan, best-case scenario, we don't get sick at all. We never have to go to the doctor. We're just going to pay our monthly premiums. Nothing else ever happens. And that's going to come out to $17.20 a year. $1,720.20 a year. Best case scenario with this middle plan, the unlimited copay plan, is that we never get sick, we never have to go to the doctor. we're going to pay about $1,200 more, $2,965 a year. And down at that bottom with those limited copays, you can see it's $1,834 a year. So the top plan and bottom plan are fairly close in the yearly outlay. But what happens in the absolute worst case scenario? We get really, really sick, and we have to go out and have a lot of surgery and have to go back and forth to the doctor, and it's a terrible year for our health-wise. Worst year, we're exposed to the most liability we possibly can be with this high-deductible health insurance plan. You can see the most we're ever going to pay is that $1,720.20 in our premiums, plus that $5,000 total out of pocket. So the worst year we can ever have in terms of our health, our maximum liability here is $67.20. Now look at this middle row. Worst year we could possibly have, our total liability is $8,965.68, plus $35 every time you go see a doctor. Because remember, that copay doesn't count towards your deductible. And once you meet your deductible and you're out of pocket, you still have to pay that copay. So there's no max, there's no cap on your total liability with this middle plan here. It looks really good, you know, $3,500 deductible and unlimited copays, but you're actually paying $1,200 a year more to be exposed to an extra $2,200 of liability right up front, plus an unlimited number of copays each year at $35 a pop. That's never going to stop. And this bottom plan here, you know, we saw the premiums were fairly close in a best case scenario, but look at the liability we're being exposed to. Worst case here, it's $8,334. That's a huge jump over the $67.20 we see in the top row. To make this middle plan financially viable, you would have to go to the doctor once a week, every week, for the rest of your life. That's it. You couldn't get any prescriptions, you couldn't go to the hospital, you couldn't have any surgery, you couldn't have any outpatient procedures. You just have to go to the doctor once a week, every week, and this middle plan would start to come close to making financial sense. This bottom plan never is going to make sense. If you just look at the bare facts here, you can see it's plain as day. You're exposed to less liability, and you're paying less for it with this high-deductible health insurance plan. The whole point of insurance is to limit your liability and to limit your risk exposure. That is why insurance exists, and it is very, very clear which of these policies is doing the best job. So the difference here, high-deductible health insurance plans have a lower premium, you're exposed to less liability, they're eligible for that health savings account, which is going to allow you to shelter a little bit of money with some tax-free growth. It has a little bit higher upfront medical costs, like if you go to a doctor or have a prescription filled or have an x-ray done. But that's much, much more than balanced out by the difference in premiums and the difference in liability. The cost-benefit analysis here is simple. High-deductible health insurance plans make sense. They make sense. The cost gap alone, it makes it very, very difficult for a copay style plan's benefits to ever catch up to where a high-deductible health plan starts. The difference in premiums is that significant. And if you look at the total liability and include that in the picture, it's a no-brainer. And if it's a no-brainer for you, it's going to be a no-brainer for your clients as well. So all of those clients that are out there and they hear health insurance and the only thing they can think of is that copay style plan that they've thought of at work, you're going to blow their mind with this. You're going to make a lot of sales and they're going to be very, very happy to have heard about it. So that's going to wrap us up for selling high-deductible health insurance plans with the Independent Life Insurance Agent Association. If you enjoyed this webinar and you want to learn more and get some more in-depth training about things like selling high-deductible health insurance plans or selling life insurance and annuities or Medicare products, come visit us at iliaa.org. We hope that you've learned a little bit about how to fit high-deductible health insurance plans into your portfolio today, and we look forward to seeing you on the association site soon. Remember, that's iliaa.org. Thank you for joining us.